It's a sad fact that our national debt has never been higher, and the taxes are more likely than not to increase for future generations. And I observe this as an estate planning attorney with my clients, many of whom are retirees and enduring a certain amount of stress in retirement due to tax concerns. So I learned to appreciate tax strategies in my practice, and one of my favorites is utilizing what we call high cash value whole life to generate additional tax-free retirement income. It's a powerful strategy, and I'm really looking forward to Barry's example with his client, where he set up a successful strategy to generate a high level of additional tax-free income. So if getting 2.5 times the cash that you put into a policy in tax-free income sounds interesting to you, give this example with Barry a listen. Then I'm going to jump in with some key points after the fact and give you some action steps if this applies to you. Take it away, Barry.
Thank you, Steve. The case study we're looking at today is on a 40-year-old business analyst. I'm going to show you how he turns $240,000 of premiums into $550,000 of tax-free income and still leave some permanent death benefit for his family upon his passing. He's putting in $1,000 a month for premium, which is $12,000 a year. You'll notice that his net cash value in year one is $10,332. This is a properly structured whole life policy to maximize cash value growth. So the majority of that $12,000 is going directly to cash value. Every year that goes on, you see the cash value growing, and it will continue to grow. As a matter of fact, notice the increase of cash value that you see here. This column is entitled Increase in Net Cash Value. As the $12,000 goes in, you can see that his cash value is always getting larger from one year to the next. And Steve, that's due because of the guaranteed return and the annual dividend that we see here in this column. These policies are guaranteed to grow cash value every year. In a properly structured policy, we're focused on high cash value growth, and we want to minimize the death benefit. He's only paying for $25,000 of actual whole life insurance, but look at this first year death benefit, $247,000, and it will continue to grow over time with a term rider. This particular policy has a 20-year term rider. We add the term rider to make the policy more efficient, raise the MEC limit, and allow more cash to go into the policy. He's going to fund the policy for only 20 years. So you see here at the end of age 60, he's not putting in any more premium. All these zeros show that he is no longer putting any more premium into the policy. But Steve, look at the cash value. It still continues to grow even though he's not funding any more premiums. He can use this policy cash value throughout his life. All this money is accessible and available to him. But we also want to show how he turns these premiums into tax-free income. $12,000 a year over the course of 20 years is $240,000. He's put $240,000 into the policy and no more premiums going in starting at the age of 61. Steve, what we now want to show is income, tax-free money that he can begin to take anytime he wants in retirement. At age 66, he's going to begin taking income out of the policy. Remember, he stopped funding premiums at the age of 60, and we're going to let the policy cash value grow for 5 years until he is age 66. At age 66, the income he takes out is going to be $25,000 a year. Now, it doesn't have to be an even number. Some years he could take $15,000 out, other years he could take $30,000 out, etc. We're going to show a consistent $25,000 a year, and this will continue for a total of 22 years. This column is our income column. So through the age of 87, he's taken out $25,000 a year. I use age 87 based on life insurance mortality tables a healthy male today, statistically speaking, will live to the age of 87. Remember, he put $240,000 into the policy, $12,000 a year over 20 years. He's able to take out $25,000 a year for 22 years, $550,000 of tax-free income. And if he passes at the age of 87, he's still able to leave his family an $82,000 tax-free death benefit. So in total, he put in $240,000. He took out $550,000, Steve, completely tax-free as income. Plus, he can leave his family another $82,500 for a total of $632,000. That's a combination of his income and a benefit that he leaves to his family. Amazing policy design, amazing policy use. This is a policy that has living benefits that allows this client to use money and cash value throughout his life and a lot of tax-free money in retirement. Remember, these properly structured whole life policies are guaranteed to grow every year. The cash value is liquid. In most states, the cash value and death benefit are protected from lawsuits, creditors, even bankruptcy, and you're growing money tax-free. So as you can see, amazing benefits that you get throughout your life. Back to you, Steve.
Thanks, Barry. Great example of creating tax-free income in retirement. Barry's 40-year-old client put $12,000 a year into the policy over 20 years with a total input of about $240,000. Then he gave it 6 years and that policy continued to grow. And at age 66, he started taking money out of the policy to the tune of $82,000 a year annually. So $240,000 paid in and over $500,000 coming out of the policy, tax-free retirement income. That's great in and of itself. The thing to keep in mind is Barry's client also had living benefits available from that cash value for things like long-term care, chronic, critical, terminal illness. These are all important factors when you set up a plan like this for retirement. If this sounds interesting to you, Barry's calendar link will be below wherever you're watching this video. I encourage you to schedule a one-on-one to look at your own numbers. You can also leave any comments or questions for us. We do respond to all comments if you keep it classy. And with that, thanks so much for joining me, and I'll see you in the next video.